Hey traders, I'm Charles, your AI assistant at Pipdemy. Today, we're diving into Keltner Channels, a powerful indicator that helps identify trends, breakouts, and volatility. Unlike Bollinger Bands, which use standard deviation, Keltner Channels rely on average true range (ATR) to measure price movement. This makes them smoother and more reliable for trend-following strategies. If you've ever struggled with spotting trends or breakouts, this tool is for you. Stick with me, and by the end of this lesson, you'll know exactly how to use Keltner Channels to level up your trading. Let's get started. Keltner Channels are made up of three lines. Middle line, a 20-period exponential moving average, EMA. Upper and lower bands. These are ATR-based deviations from the EMA. So how do we calculate them? Middle band, our 20-period EMA. Upper band, our EMA, plus ATRX multiplier. Lower band, our EMA, ATRX multiplier. The ATR multiplier, often set to 2, determines how wide the bands expand. The larger the multiplier, the wider the bands. Now that we understand the math, let's see how to use this in real trades. Keltner channels are excellent trend indicators because they adjust dynamically to volatility. In an uptrend, the price moves near the upper band while the middle line acts as support. In a downtrend, the price stays near the lower band and the middle line becomes resistance. In a sideways market, price moves between the bands, signaling consolidation. Pro tip: if price stays above the middle band for an extended period, the trend is strong. If it crosses below, momentum is weakening. Next, let's see how to use this for breakouts. Breakouts can be tricky, but Keltner channels make spotting them easier. When price breaks above the upper band, it signals bullish momentum, potential for an uptrend. When price drops below the lower band, it signals bearish momentum, potential for a downtrend. But watch out for false breakouts. Always wait for confirmation before entering a trade. Volume increase, plus strong close outside the bands. Higher breakout reliability. Weak closes or fast pullbacks. Possible fakeout. Now let's compare Keltner channels with Bollinger Bands to see which works best for your strategy. Many traders confuse Keltner channels with Bollinger Bands, but they have key differences. Bollinger Bands use standard deviation for calculations, expand and contract more aggressively, best for spotting overbought and oversold levels. Keltner channels use ATR for smoother trend following, less volatile and easier to interpret, best for trend confirmation and breakouts. Which one should you use? If you prefer smoother signals, go with Keltner channels. If you want high volatility setups, Bollinger Bands are better. Or why not use both for extra confirmation? Now let's talk strategy. Here are two powerful ways to trade using Keltner channels. 1. Trend following strategy. Enter long when price bounces off the middle line in an uptrend. Enter short when price touches the middle line in a downtrend. Exit when price reaches the opposite band. 2. Breakout strategy. Wait for price to close outside the upper or lower band. Confirm with volume and momentum indicators, e.g. RSI, MACD. Enter a trade in the breakout direction with stop loss at the middle band. Want an edge? Combine this with Bollinger Bands or moving averages to avoid false signals. Awesome job, traders! Let's quickly review what we've learned. Keltner channels track trends and volatility using ATR-based bands. The middle band acts as dynamic support and resistance. Breakouts need confirmation to avoid false signals. Combining Keltner channels with other indicators boosts accuracy. Pipdemy is here to help you trade smarter. Keep practicing, and I'll see you in the next lesson.